Dear friend, thanks for watching our YouTube channel. Today we will be presenting a very good topic. Our small request to you is, please subscribe the channel, like the video and share to others. Your inspiration will motivate us. Thanks a lot. Happy watching.
Welcome to Options and Ideas topic, all about bank guarantee in loan. A bank guarantee is a financial instrument issued by a bank on behalf of a customer, promising to pay a specified amount of money to a beneficiary if the customer fails to fulfill their contractual obligations. It serves as a form of security or assurance for the beneficiary, ensuring that they will receive compensation if the customer defaults or fails to meet their obligations. Bank guarantees are commonly used in various business transactions, especially in the context of loans, contracts, and international trade. Here's a comprehensive overview of bank guarantees in the context of loans. For example, A enters into a contract with B for completion of a certain project and the contract is supported by a bank guarantee. If A does not complete the project on time and does not compensate B for the loss, B can claim the loss from the bank with the bank guarantee provided. Why is bank guarantee needed? A bank guarantee serves as a promise from a commercial bank that it will assume liability for a particular debtor if its contractual obligations are not met. In other words, the bank offers to stand as the guarantor on behalf of a business customer in a transaction. Eligibility criteria for a bank guarantee. The most common criterion is that the customer must have a good credit history with the bank. Other criteria may include the customer having a certain amount of money in their account or having a certain type of account with the bank. Who gives bank guarantee? A bank guarantee refers to a commercial or financial instrument that is provided by a bank, where the bank assures or guarantees a beneficiary that it will make the payment to the bank in case the actual customer fails to meet his or her obligations. How long is a bank guarantee valid for? As per this Act, bank guarantees must have a limitation period, and the claims can be made on them only within this period. Usually, the limitation period for bank guarantees in India is 12 months over and above expiry date of bank guarantee. If a claim is not filed on a bank guarantee within this period, it expires. Advantages of bank guarantee. A bank guarantee helps bring down the risk associated with the transaction. It pushes sellers to grow their business on a credit basis because of the low risk. Guarantee fees are often cheap, which is advantageous for even small businesses. Disadvantages of bank guarantee. Strict assessment by banks. When the applicant approaches the bank seeking a bank guarantee, the bank assesses the applicant's creditworthiness and financial health. The bank makes an elaborate financial analysis of the applicant before issuing such a guarantee. Sometimes, this process becomes quite complicated, leading to either obtaining no guarantee or causing hindrances in getting a guarantee. A bank guarantee is a financial instrument provided by a bank on behalf of its customer, usually a borrower, to guarantee payment to a third-party beneficiary in the event that the customer fails to fulfill their contractual or financial obligations. It is a commitment by the bank to make a payment to the beneficiary up to a specified amount if the customer, applicant, defaults or does not meet the terms of the agreement. Bank guarantees are commonly used in various business transactions, such as securing loans, entering into contracts, participating in tenders, and conducting international trade. In the context of loans, bank guarantees can serve several purposes. 1. Loan security. When a borrower obtains a loan, the lender may require some form of security to mitigate the risk of default. Instead of providing tangible collateral, the borrower might opt to offer a bank guarantee. In this case, if the borrower defaults on the loan, the bank will be obligated to pay the lender the guaranteed amount. 2. Contractual obligations. In some loan agreements, particularly those involving project financing or construction projects, the borrower may need to fulfill certain obligations. A bank guarantee can be issued to ensure that these obligations are met. If the borrower fails to meet the terms of the agreement, the bank will compensate the lender. 3. Trade finance. Bank guarantees are also used in trade finance to ensure that payment is made for goods or services as per the agreed terms. For example, an importer's bank might issue a guarantee in favor of an exporter, assuring the exporter that payment will be made once the goods are delivered in accordance with the contract. Key elements of a bank guarantee. Applicant, the party, usually the borrower, requesting the bank guarantee to secure their obligation. Beneficiary, the party, lender, contractor, supplier, etc., who will receive payment from the bank if the applicant defaults. Guaranteed amount, the maximum amount stated in the guarantee that the bank is liable to pay to the beneficiary. Expiration date, the date when the bank guarantee expires and is no longer valid. Terms and conditions, the specific conditions under which the bank guarantee will be invoked, such as non-payment, non-performance, or other breaches of contract. Issuing bank, the bank that issues the guarantee on behalf of the applicant. Counter guarantee, in some cases, the issuing bank might require the applicant to provide collateral or cash as security, referred to as a counter guarantee. This ensures that the bank is protected in case it needs to fulfill its payment obligation to the beneficiary. It's important to note that issuing a bank guarantee usually involves fees paid by the applicant to the bank. The cost of the guarantee will depend on factors like the guaranteed amount, the duration of the guarantee, the perceived risk, and the prevailing market conditions. Bank guarantees are complex financial instruments with legal implications, and parties involved should carefully review the terms and conditions before entering into such arrangements. If you are considering a bank guarantee for a loan or any other purpose, it's recommended to consult with financial and legal experts to ensure you fully understand the implications and requirements. 1. Types of bank guarantees for loans. There are different types of bank guarantees that can be used in the context of loans. 1. Performance guarantee. This type of guarantee ensures that the borrower, applicant, will fulfill their contractual obligations as per the terms of the loan agreement. If the borrower fails to meet these obligations, the bank will compensate the lender, beneficiary. 2. Financial guarantee. This type of guarantee ensures that the borrower will meet their financial obligations related to the loan. If the borrower defaults on their loan payments, the bank will cover the outstanding amount. 3. Advance payment guarantee. In some cases, a borrower might receive an advance payment from the lender. An advance payment guarantee ensures that if the borrower fails to deliver as agreed, the bank will refund the advance payment to the lender. 3. Bid bond or tender guarantee. When a borrower participates in a bidding process, they might be required to submit a bid bond or tender guarantee. This ensures that if the borrower wins the contract but fails to sign the contract or provide the required performance guarantees, the bank will compensate the project owner. 2. Process of obtaining a bank guarantee for a loan. Application. The borrower applies to their bank for a specific type of bank guarantee, detailing the purpose, amount, terms, and beneficiary information. Due diligence. The bank evaluates the borrower's creditworthiness and assesses the risk associated with providing the guarantee. The bank might require collateral or a certain level of funds to be deposited as security. Issuance. If approved, the bank issues the bank guarantee document, specifying the terms, conditions, and amount of the guarantee. Invoking the guarantee. If the borrower defaults on their loan obligations as per the terms specified in the guarantee, the lender, beneficiary, can invoke the guarantee by presenting the necessary documentation to the issuing bank. Payment. The issuing bank will make the payment to the beneficiary up to the guaranteed amount if the default conditions are met. 3. Advantages and considerations. Alternative to collateral. Bank guarantees provide an alternative to traditional collateral, which might be more convenient for borrowers who don't have significant tangible assets to pledge. Flexibility. Borrowers can negotiate the terms and conditions of the bank guarantee, making it a flexible option to suit various loan scenarios. Risk management. For lenders, bank guarantees mitigate the risk of borrower default, offering assurance that they will receive payment even if the borrower defaults. Cost. Bank guarantees typically involve fees, including issuance and maintenance charges, which can vary based on the type of guarantee, the amount, and the issuing bank's policies. 4. Legal aspects. Bank guarantees are legally binding agreements, and the terms and conditions must be carefully drafted and understood by all parties involved. In case of disputes or defaults, the legal implications can be significant, so it's crucial to consult legal experts when drafting and signing bank guarantee agreements. Remember that the specific terms, regulations, and processes surrounding bank guarantees can vary based on the country, jurisdiction, and the bank's policies. If you're considering obtaining a bank guarantee for a loan, it's advisable to consult with financial advisors and legal professionals who can guide you through the process and ensure that you're making informed decisions. Thanks.
Thanks for watching the video. Our address is Options and Ideas, 28L, Jheel Road, flat number 1A, ground floor, Kolkata, pin code 700031. West Bengal. Website www.optionsandideas.com and optionsandideas.org. Contact 93300366513.